Hi, I'm Tobias Carlisle. This is the Acquirers Podcast. My special guest today is Elliot Turner of RGA Investment Advisors. He is the Twitter guru. We're going to talk to him about valuing Twitter, where he sees the PayPal opportunity, and his investment style right after this.
Tobias Carlisle is the founder and principal of Acquirers Funds. For regulatory reasons, he will not discuss any of the Acquirers Funds on this podcast. All opinions expressed by podcast participants are solely their own and do not reflect the opinions of Acquirers Funds or affiliates. For more information, visit acquirersfunds.com.
I don't know how long I've been aware of you. I was definitely aware of you before we met on Twitter, possibly because you were writing that blog, right? You were writing something.
Yeah.
When did you start writing?
Yeah, writing was one of those things. I never actually planned to do it per se. When I started I had blogs as basically projects while I was in law school. I actually started a podcast in law school with a couple friends, and we had 20,000 downloads. One of my friends, who now is working at Google, was building. At the time, he was just working for one of the large agencies, and he had heard about podcasts. He heard how you could build RSS feeds for distribution, and he wanted to play around with the technology. And he wasn't one of my Fish friends. Like, a bunch of us were really passionate about the band Fish, and we would follow them around, go to a lot of concerts, and etc. We created a podcast called Trapped in Time that you could find on the Internet Archive after Fish had retired at the time. They're now back, thankfully. And this podcast was huge. It blew up. And I was writing alongside it on that. I had a personal blog where I'd write about just anything that was interesting to me. I had connected with other people who were writers, and I never had a specific plan, but I think one of the beauties of the early internet was you could do whatever the hell you wanted, and there was a lot of white space. And when I was working, it was really the second prop trading firm I was at, and we could talk a little more about, my origin in this business formally. They had a pretty robust online presence, and they were building out their own blog, and they basically said to me, you could do whatever you want with this. So I started writing daily posts. After I left that firm, I was writing for the Wall Street Cheat Sheet every day, pushing stuff to Seeking Alpha. Then I started my own blog called Compounding My Interests, which is something I really wish I could keep up with again. I'm actually I kind of reserved the Substack domain for that, and I have these ambitions to start writing again, and I feel like I have an interesting story to tell to get it launched. I was going to do that before the whole COVID period started, and we then had no daycare and school for our kids, and that kind of consumed some of the time I was going to commit to that. But I'm the one thing I'm sure of is I'm definitely going to get back to it. So always been doing writing here and there and been interested in that.
What would you do? Would you share your research as you do it? Is that too proprietary? You just share something else more broad?
Well, at the time when I was doing it, it would be generous to call it research. It was more like my explorations as someone who is interested in markets and who wanted to learn. So I was sharing a combination of what I found interesting and the pieces that I was learning, and throwing my ideas out there. And it was, I think one of the things that people underestimate in this all is, they think I need to blog or I need to do this and have a plan to get something out of it. Yeah. And just doing it, first and foremost, it forces you to kind of center and anchor on your own thoughts. There's a very big difference between having an idea in your head and having something that you can put on paper and actually make airtight and let it stand up on its own. So forces you to think and think clearer than you would if you were just kind of aggregating and compiling ideas in your head. It's something that's a history, so you could reflect on your past and hold yourself accountable, make sure you're improving and moving forward. And then so much serendipity happens from it. The fact that I was blogging and putting out these ideas, and I'd reflect back on it and say wow, I'd hardly call myself an investor, but there were people out there who were hey, I kind of like what you're doing here. We're talking about 2007 to 2009, and these people have been burnt in the financial crisis, and they're I got absolutely annihilated. I didn't like the people who were managing my money. I'd love for you to find a way to be able to manage my money. And, obviously friends and family are some of the first readers, but like when you throw things out on the internet, it gets a lot farther than you'd ever imagine. And so it was fun. And like, I met so many great people through it. I got into like interesting conferences because they're like, oh, you have a blog? Why don't you come and just write about it? And, all kinds of things that you'd never imagine. And, I never had a plan, never had like ideas. Basically all I had was a promise to myself that, I'd try to get better every day, and that I wanted to look at myself yesterday and say, wow, I got better today, and look at myself, 5 years ago and be like, that guy was so clueless.
He didn't know what he was doing.
And I think that's the one. Exactly. And that's really how I feel. I'm like, hopefully I keep thinking that about myself, though, coming from like a much kind of higher plateau today than when I was starting.
It is one of the really nice things about this business in particular, that you really don't ever get to a point where you know everything. You just, this is one of the things that I've discovered. The more I understand about value investing, the more I understand what a phenomenon Buffett is, for example. There are things that, and then the weirdest thing, when you go back and read the letters again, I think I have a new insight, and I go back and read the letters, and I'm like, oh my God, he was talking about this in 1983. Like, he covered this years ago and dismissed it immediately. Like, just thought about it, dismissed it, and moved on.
It's truly unbelievable, right? And I'd imagine from your seat too, you get to speak to an interesting person every week. You get to pick their brain, and I'd imagine that provokes a lot of questions in your head and a lot of reflection, and like, what can I do to, like, what lessons do I want to take from this conversation? What can I internalize myself? And, you also have basically effectively a journal that's out there of your own thinking and your own evolution. And by the way, like, your book, Quantitative Value, was incredibly influential on me early on. And I'm like, wow, look what Toby's doing. This is amazing. Putting these ideas down on paper, and it like really stands up. It's something that's like, one of the things that actually got me stopping writing was I started putting this pressure on myself that I didn't want to write it if I didn't feel that it could withstand the test of time.
Yeah.
So at first I was writing these ephemeral things like, oh, look at what, this stock did today. And it's like, that's junk. Like, I don't really want to be doing that. Like, I don't want to be a keyboard monkey like that. I want everything to be thoughtful. So then it turned from a daily cadence to a weekly cadence to a, my God, I'm holding myself to way too high a bar. I can't write again. And then it's 3 months and I'm like, well, my first one back has to be good. So, what could I write that's good? And then, more time transpires, and now it's been a couple years. That said, I do write a quarterly letter now. So like every quarter I do actually put pen to paper and like formulate my thoughts, but that's a very different exercise than blogging. I view blogging more like journaling. And, like you said with Buffett and his letters, I think one of the coolest things I've ever read, I don't think enough value investors read George Soros. If you read Alchemy of Finance, the journal in the
reflexivity
half, yeah,
of the journal,
exactly. Yeah, reflexivity is an amazing concept. And what's cool, I think, is he has this actual where, so not only does he introduce you to the concept, but you could see his ideas evolving from one day to the next. And, he'll tell you the day that his back is aching, and you could kind of get a contextual understanding for like why he felt certain ways about different positions. And so, I think that's important for each of us to do for ourselves too, in one way, shape, or form, at least periodically. Like, it doesn't necessarily have to be every day, but periodically to jot down like our thoughts and our thoughts about our own thoughts, and kind of like, really reflect on that. It's one of the most important things.
You started out, so you went to law school, and then you were going to become a sports agent in the NFL. So how does the law school, do you apply? Did you practice as a lawyer at any point there?
Never, and I never intended to.
Yeah, that's smart. But it's still a useful framework for thinking through ideas. Do you still use that framework at all as you're investing?
So I was actually talking about this with my wife the other night. I long said the best thing I got out of law school was a beautiful wife. And, we met in our 3L year at law school. And interestingly, I've long asserted that I had to rewire my brain to think differently than lawyers are trained to think, because lawyers are taught to kind of like understand where their confines are and work within those in maybe a creative way, but not necessarily very creative, like focus on semantics and, like find their angle, but very rigid structures within which lawyers work. But on the flip side of things, like, so I've long asserted I had to rewire my brain. But then the more I think about it, one of the interesting concepts from law that I've really started to appreciate, right, is this idea of common law, where you start with ideas and principles, and like you keep refining and pushing forward those ideas and principles based on actions that happen that are like nuanced from where the original was established, and you keep advancing this thing forward. And like it's not like there are specific laws that are written in stone, there are kind of different perspectives that you could take to it. And I really like this idea of like common law as being this dance and an evolutionary process where it kind of like adapts to the reality of your culture and time, and the realities of your culture and time kind of push it. And it's kind of this feedback loop and symbiosis and kind of evolving toward a higher place. So I've like reconsidered I had to rewire my brain. And it's like, actually, I should have been thinking about it from this angle.
There's two elements to it, right? There's the idea that you're bound by the decision that you're bound by a previous decision, and so your new decision has to be consistent with that previous decision. But then you have additional facts, so it's a slightly different circumstance, and then you have to apply that same sort of consistency to the new circumstance, and it evolves in that way. And it's this very organic evolution of it, and it's probably useful for that reason.
And you have law in your background too, right?
I practiced,
you really
sadly, as an M&A lawyer, in the US, in Australia and the US for 8.5 years before I was able to escape.
Amazing, yeah. And what's interesting with your phrasing, like when you said it like that, it's like, wow, it's actually kind of like a Bayesian framework, right? You start with your anchor and you give a lot more weight to your starting point than your incremental information, except your incremental information could keep moving you. And I think, thinking probabilistically in that way is one of the most important things we could do as investors. Like we're trying to build this mosaic based on a whole pool of information we have. And we know that it's imperfect, and we know that the future is going to be different than the past. And we're inherently flawed as forecasters. We can't make very good predictions. So it's about balancing, like how much weight do we give to what we know in the past, and how do we weight incremental new information? And that's kind of like the way you phrase common law. That's what it is, right?
So you spend a little bit of time as a sports agent.
Well,
or in a sports agency.
I was working for them between my 2L and 3L year, and I was going to work. That was what I was hoping to do on the way out.
But then you become a prop trader.
Yeah, so transition sounds a little too smooth. It was really a mess. And this is, I think, when I inevitably put pen to paper on that Substack I'm talking about, I'll write about the intervening event or events, however you want to speak of it, that led me into, or really back into the finance world. I, instead of actually working in the sports agent world, had someone who like aggressively tried to hire me and offered me a whole lot of flexibility that otherwise I wouldn't have had. And I worked for that person for about 6 months formally, and it was just a terrible, nightmarish experience. And when I was fired on the day before Thanksgiving in 2007, I was like, what the hell do I do now? Like, I don't really want to work in that world. I was so jaded from what I had seen, being exposed to, a kind of really strong personality in the sports world, that I was like, I really need to do something different. I had a passion for the stock market since I was lucky. In the 4th grade, Mrs. Burdick was my teacher, and she taught me. She gave everyone in our class an enrollment in the Newsday stock market game, gave each of us the Berkshire annual report, told us who Warren Buffett was, and introduced us to this idea of investing. And I'd always known that no matter what I did, like I wanted to be involved in the stock market. And I could talk a little more about like what I'd done, like messing around and getting caught up in the dot-com bubble. But, I knew I wanted to do something in investing. 2 of my close friends from college ended up working at this firm, Chimera Capital in New York. And so, I was really looking for jobs. The job market wasn't where, ideally, you wanted it to be, as 2007 was turning into 2008. And we were, not long before Bear Stearns actually collapsed. And, I was thinking about, like, what do I want to do? My friends love their job. I love the stock market. I'd already been, like, messing around with some of my own money there. And this firm was hiring aggressively from Emory University in Michigan, which they had great success with. I went to Emory. I'm a natural fit. It was a really good setup. And, so I took a seat on a prop desk. Now, prop desk sounds glorious, but it was really like day trading keyboard monkey.
How does it work? What do they do? How does it work? They give you $1 million of the firm's money to trade, or how does it
All
work?
of that business model and their approach toward training and trading is a lot better than any other that I've since learned about. But effectively, what they do is, there's a robust training program. You start paper trading. You have to prove that you're not going to blow up on paper. And then they give you, they start you with like $100,000 of prop capital. I think they're levered something like 20 to 1. So like the actual pool of capital is really small. Can't hold any positions overnight. And you're really just a keyboard monkey. It's not too different than playing like a video game. And at the time, it was really.
How do you make money if you can't hold overnight? What do? You're like literally just you're trading the lines on the screen.
It actually wasn't even the lines in the beginning. It was far more focused on, you could actually see depth in the order book, and you'd see where like bids and asks were. And it was really, in effect, to speak bluntly about it, you're trying to front run large orders that you see. And you'd get in front of them and you try to scrape, with 1,000 shares, call it like 30 cents in a stock, and do it over and over and over. And you're making, you're really churning through a whole lot of commissions to try to make money. And there's some people who, especially at that time, were absolutely phenomenal at it and could do incredibly well. But I never liked it. It never struck me intellectually at all. A lot of it is really behavioral though. One of the things I love and respect about Chimeric deeply is that they empowered people to think and to indoctrinate people that there's no one right way to make money in markets. Like making money in markets is about finding a strategy that fits your personality. And, it doesn't have to be any one right way. Everything's about the quest for conviction behind your ideas. And you have to get yourself in position to have these ideas, have conviction behind it, and, manage risk in an appropriate framework. And one of the things I've said to a lot of people, I've seen people who especially as you get better and they do let you take overnight risk and you could start swing trading and doing, things that get closer to investing, but not quite in investing. I've seen people risk manage their way to fantastic returns. They didn't know a single thing about the instruments they were trading. They didn't know a single thing about companies or business analysis. They just really understood and internalized risk management. And I think that's left a strong impression on me as I've, developed my own trading strategy, that it has to fit my personality, that there's no one true answer. So explore and learn about all that everyone comes at this from, and, always be disciplined and rigid with risk management.
How do you characterize what you do now? How would you describe, like an optimal opportunity, or your process for getting to that optimal opportunity?
Yeah, so there are two things that I'd say are important to me. I started in this professionally in the day trading world, except I'm what you call low turnover now. This is the first year we'll have exceeded 20% turnover in the portfolio. So once again, rewiring my brain from going from hitting buttons like that to holding things for a long time, right? 20% turnover means a couple things to me. One is it means that you really only need to come up with a handful of ideas in a year if you have an average position size of about 5%, right? So slow things down, right? Be methodical, take a slow approach toward it. And the other means, when you have a 20% turnover, roughly speaking, you're talking about holding a position on average 5 years. Right. So I'm really looking for long-term investment opportunities. I'm looking for businesses who, my return is going to be driven far more by the business itself than it will be by, a re-rating of the multiple or anything of that sort. Right. And so when I describe myself, I hate labels, I hate having to categorize myself. But one of the beauties, I think, a label like GARP, which I fully subscribe to, depending on the market environment, I could end up more on the value side of the GARPy spectrum or the growthier side of the spectrum. And I don't have to be beholden to one or the other, but I do have to, at all times, anchor myself to valuation, right? That's a religion. I'm indoctrinated there. I can't just say, this business is qualitatively awesome and I'm willing to buy it at any price. And on the other end of the spectrum, on the other hand, I also do have to say, okay, I'm not willing to purely buy a melting ice cube. That doesn't fit my setup. I have to have some sort of structural growth in this business, some sort of opportunity for them to be a little bigger, tomorrow and thereafter than they are today. And I think that's really important to me.
Well, let's talk a little bit about some of the positions. So we've had a conversation. We had a conversation yesterday about a couple of positions that I love your insights on them. And Twitter's one that you're well known for being quite bullish on Twitter, and it's how we met. Or it's one of the I think I said that I think that you were one of the first people that I ever interacted with on Twitter. I'm almost certain that
Truly amazing.
That's the case. I'd have to go back and have a look at it, but that would be like 2009. I think that's probably not right, because I think I signed up in like 2009, but then I didn't use it for a couple of years. And I think that you pointed out it was around the time that Google Reader killed itself. And so Google killed the reader, and then everybody had to go and find another. They killed the homepage and they killed the reader. And all of a sudden Twitter became the homepage and the reader, which is, I think that's exactly what happened to me.
Yeah, so I mean, one of the funny things is when I was telling you about my start in the podcast world way back in 2004.
You could be a podcast billionaire.
I know.
Now.
I had a huge following.
You could be that's before Joe Rogan.
Exactly. Could have made it huge and had a big audience and all that sort of stuff. That same friend was like, "This Twitter thing is awesome. Don't really know what it's going to be, but like you should check it out." I created an account, and really its only function was like when I'd write a blog post, it would send an automatic blast to Twitter saying like, "Read this." So I didn't actually like tweet or engage with people. But in Google Reader at the time, and I understand you did the exact same thing as me, I had this social circle of my friends who were interested in the same things, and, you know, like a slightly different group in finance than I did in, call it fantasy baseball and, you know, music. And we'd share things through Reader, and we'd each read each other's things. And, you know, I mean, I really was very into RSS and thought it was like, you know, the best thing ever, because this was how I kind of curated my own reading list, and I religiously read it morning, middle of the day, and evening. And when Google killed Reader, I was like, oh my God, what do I do now? Like my whole, like, I don't know, call it intellectual development was built on this one platform, and now it's gone. What do I do? And I was like, okay, maybe now's the time that I explore this quirky thing called Twitter. And I started engaging on Twitter, started talking to people, started connecting to people. You know, I don't even think there wasn't exactly FinTwit. There were like certain clicks at the time. And really for me, it was an exploration of like learning how to invest, like, you know, following what's interesting. Back then, I definitely spoke a lot more macro than I did business analysis, though, you know, there were shades of both that were like mixed in along the way. And, you know, I think I'm so grateful. Like, thank you, Google, for killing Reader. I was so devastated at the time, but it's like one of the best things that's ever happened to me. It's opened so much serendipity. Like, being involved in Twitter has been huge. So, you know, like early on in Twitter, I think in the grand scheme of things, I was very early to Twitter and to appreciate Twitter. Now, when Twitter was IPOing and you could see my tweet history, you know, I really felt that it was overvalued, and the expectation of this platform was just way too much for what it was. And so, like, I wrote down on paper at the time, like, take notice of this thing when it gets to a $10 billion market cap. Like, that's what I thought would be interesting. Like, it was a little too much at that time. Expectations were too high. I mean, I don't even know, like, a lot of what I ended up knowing by the time I invested in it. But, you know, it was a little bit of a mess. $10 billion seemed like the right spot. And if I recall, it was something like, I don't know, 40, 50 billion in the early days when it came public. And, you know, but see, one of the things in my process that I've always done is I started, like, I think one of the things I internalized that Buffett said is there are no called strikes. Like, there's no situation that you have to be involved in, but, you know, that does mean that, like, it doesn't mean it's not worth paying attention to things that are expensive but interesting, right? Learn about them when they're new, learn about them when things are going well, and then one day there might be an opportunity where, well, you know, Mr. Market gets a little less sanguine and you could step in, having understood it this whole time and having applied like a Bayesian framework, updating your understanding of the business as time goes on. So when Twitter hit their problems, like, I was really paying attention and I was really interested and digging in deep there.
Well, let's talk a little bit about it, because it's been, I absolutely love the product, and I think it's incredibly powerful across a number of different, from a research perspective, from getting news, from a marketing perspective. It's great. It's a great tool for all of those things. The the problem has always been that the business hasn't been great. You know, Mark Zuckerberg famously described it as a clown car that fell into a gold mine. And it's had this part-time CEO who seemed to be running the more fun business that was doing quite well. And, it's got all of these sort of ongoing issues, but certainly something seems to have changed since, and maybe I'm wrong, maybe it hasn't sort of, maybe it was always this way, but I feel like when Elliot sort of popped up on
me,
board.
Elliot, the activist.
No, yeah, sorry, Elliot yep. Management, Elliot, Paul Singer's Elliot, because that's got to be the toughest guy out there, right? And he's a very, very shrewd investor. So if he's on Twitter's board, then you sort of, or if Elliot's on Twitter's board, then you have to think that something very interesting potentially could happen there. So how important are they to what Twitter was doing? Or do you think that even without those guys, and maybe just talk a little bit about what they're doing?
Here's a funny thing. Someone on Twitter thought I was the Elliot who is, the Elliot that wedged their way onto the board. That's
pretty cool.
Pick up the tweet. It was hilarious. I think it's because I'm basically like the only person in FinTwit who's actually bullish on Twitter.
I mean, what are the chances that someone who knows really about Twitter and has the same name?
Right,
yeah,
there you go. So, I think there are a few things that are going on. I actually deeply respect Jack. I think he's one of the ultimate product innovators of our time. How many people have come up with effectively 3 separate businesses that each make $1 billion? So I'm counting twice in Square because there's, Square itself for merchant and Cash App. I think some of the flack he gets is justified on the one hand, but I think it's a little unfair. Perhaps their biggest problem is they don't have a COO, and I think they had a pretty ineffective board. So I had a position in Twitter, but I didn't get really big until this March, and after Elliot and Silver Lake each got board seats. And more importantly, I think there's another key sign in there, which is that Patrick Pichette had been on the board for about a year or so. I know I'm roughly right there, but Omid Kordestani was removed as independent chair, and Patrick Pichette became the independent chairman of the board. Now, I don't know if all of you would know the name Patrick Pichette, but interestingly, he was the CFO of Google during some of their most important years. And so if you talk about a guy who really knows the financial side and understanding how to make money at a web-based advertising business, I mean, this is someone whose insights are priceless. And now in April, shortly after this reconstituted board was kind of released to us publicly, Jack Dorsey accidentally periscoped publicly and was talking about how, it was supposed to be an inter-team meeting with his team. And he's like, oh, yeah, so, now my board, in his Jack kind of mumbly sort of way, is now my board's actually paying attention and I have to talk to them regularly. And, then he's like, oh, my God, this is public. And he shut it off. You could still find the video. I think BuzzFeed kind of posted it somewhere. But to me, that was really, really important. And, thank God we got that little preview there because they have an engaged board. They have a board who, when I think about Elliot and Silver Lake, I think of it as a good cop, bad cop kind of setup where Elliot is, they wanted Jack's head. That was the headline that came out there publicly. They wanted him out as CEO. And I don't doubt for a second that that's what they wanted. And they are really disciplined when it comes to expenses in businesses and technology businesses. They've done a great job reining in some other companies. They've broken up some other companies. They've forced sales. They really get what they want at the end of the day. And then in comes Silver Lake, who buys this $1 billion convert with a 41 and a quarter strike price, which at the time, the stock was in the mid to low 30s. So they're saying, we want some upside. We think there's going to be some upside. And Silver Lake comes in, they've got a little more history in venture capital than they do in actual public activism. I'm not sure if there's any other case where they've truly gone activist. I kind of think they're the good cop insofar as, they have a history of helping businesses monetize. They have a history of growing businesses. And so they come in here and you have Elliot and Silver Lake and they kind of each bring their respective disciplines. Now, the interesting thing about the good cop and the bad cop is that, while they are seemingly diametrically opposed to one another, they're actually on the same team, right? When you think about it, the good cop and the bad cop are working together. And who are they working for? They're working for us shareholders. So it's the first time you can truly feel conviction that everyone is geared toward looking out for and answering to the interests of shareholders at Twitter. So I think that was a really, really meaningful change, and I don't think people appreciate the magnitude of that enough.
Can you break down how you think about the valuation of Twitter for us, and what the drivers that we should be looking at as we think about that too?
Yeah. So one other point that I want to make on like the structure of Twitter and coming out of this big mess before like going to exact monetization, because I think it's important for one of the most important KPIs in the business, is that, you know, when Twitter was built, Twitter was this big heaping mess. There literally was no twitter.com. Like, it was an API, and it started with over text message, but then there were these various gateways that other people built accessing the API. So there was no Twitter. It wasn't built as a site. And that's really different than a lot of these other companies that are out there in web land. And it's got its pluses and minuses, but for Twitter thus far, it has had way more minuses. And so when twitter.com became an actual site, that process was really messy. It was this group behind TweetDeck that was actually rolling up these other gateways and access points to Twitter. And so Twitter eventually ended up buying TweetDeck and building their own twitter.com. And it was like a really haphazard, like messy process. And they had a lot of code debt, and they didn't have like an actual underlying like way to build product, to push new product to market, to experiment. And, you know, they were encumbered by their past in a big way. And I think that had a lot to do with what went wrong. So when you're thinking about valuing Twitter, like how this all relates to valuing Twitter is the first refoundational piece of rebuilding Twitter when Jack Dorsey came in was like rebuilding their user experience, the whole user side of the platform. And that involved, you know, things that were not just code related. It involved making really hard choices about what safety looks like, about what it means to be, you know, make a forum where people could actually engage. And so they had to make a lot of hard choices, had to face a lot of challenging questions, were put in certain positions where they could, where some of these hard choices made sure that no one was happy. And so it's a really hard place to be. But they did it, and they just recently rebuilt their ad tech stack. But so in rebuilding the user side of things, you really started seeing the progress about a year and a half ago that user growth actually started again on the platform. They had stagnated for nearly a handful of years without being able to add any new users on the platform. So when you think about valuing Twitter, they give us like two KPIs to work with, basically. They don't even really give it to you. You have to kind of like figure out the ARPU side of things. But you have ARPU, and you have how many DAUs you have, and you have to think about, you know, how each of them are growing or not, because ARPU in particular had taken, you know, a meaningful drop this year after flatlining the prior 2 years. And so
why was that?
Okay, so in 2019, ARPU was trending upward nicely in the first half of the year.
That's average revenue per user for the folks who are
exactly.
If you didn't
exactly.
know that. So it's, sorry, I cut you off. There was $25 per user.
Yeah,
did you say?
So they are $25 per user. In 2018 and 2019. 2019 was looking like it was going to be better than 2018. But then in the second half of the year, they had these big problems with one of their revenue products called MAP. If you know those little tweets, or really on any platform, any ad that's asking you to install an app, that is MAP. And, you know, in certain markets for Twitter, especially Japan, really, really meaningful revenue product. And so like in Japan, if you kind of like figure out ARPU, you know, they don't disclose it. So roughly speaking, they were down somewhere by the order of 20% ARPU in Japan. Now, Japan's a really important market for Twitter. It's their second biggest market in the world after the US. So losing 20% of your revenue per user, you know, that's a pretty big hit. Interestingly, ARPU was up in the U.S. in 2019, but in aggregate, their ARPU was down fractionally, you know, in overall. And then obviously with COVID, ARPU took a really meaningful drop. And that had to do with the fact that Twitter itself, something around 80% of all advertising on Twitter is what you'd call top of funnel brand advertising. So it's like, you know, the Procter & Gamble's of the world who try to raise awareness about a brand, as opposed to direct response, which is what you see, you know, far more on Facebook. So when COVID happened, brand budget stopped, and all of a sudden, the floor fell out. It's really come back in a big way, and it's gotten stronger. But Twitter has to do a lot of work to improve their revenue product to kind of broaden the kinds of opportunities they give advertisers. And it really required rebuilding their entire tech stack from scratch. And there's some great blog posts on the Twitter infrastructure blog that explain why they were in this problem, what it meant, and how they could fix it. And now that the new ad tech stack was launched in the second half of this year, they could kind of iterate on things much quicker. So you're starting to see things like carousel ads. Just yesterday, they announced that they're finally doing frequency caps. And a lot of people are like, this is so Twitter. There's so much low-hanging fruit. Like, why haven't they tackled this sooner? Clown car, blah, blah, blah. And it's like, actually, I get why they hadn't done it. They weren't able to. They were encumbered by their past, and they had to, like, re-platform and build this foundational stuff. So when I think about Twitter, when I think about valuation, when I start, the first thing you could do is simply back of napkin say, well, okay, they've had huge growth in their user network the last year, nearly 30% year over year. You take that growth in the user network and say, okay, I'm going to slap on my 2018 or 2019 ARPU of $25. And I'll say, okay, look, they've given me long-term guidance on what their EBITDA margin range would look like. They've said 40 to 45% EBITDA margin range. And, they've delivered within that range in the past, though they had been below it last year. So let's say, they end up at 35% instead of hitting the low end of the range. So you take that, the 186 million users, multiply by $25 ARPU, apply that 35% margin, that's $2 billion in EBITDA on a mid $30 million market cap with $4 billion of net cash, which should be growing just if the user base keeps growing, call it, even if it slips to the mid double digits from 20%. That's pretty nice in this market for like a platform that has, I think, still a whole lot of low-hanging fruit and a lot of optionality and a lot of interesting things that they could try to capitalize on. Then if you like come at it from a DCF, the way I do it is I kind of like take them up to that 2019 ARPU by 2024, get them by 20. I'm like unfair in it because I had to like temper myself. Get them to the low end of their margin range by 2028 and apply my terminal multiple then. You're talking about a stock that should be in the mid $60. And, one of the beauties of it all is I think the best business model for Twitter might be one that they've yet to even explore. And they're finally truly dropping hints that they're going to do it. I think some sort of premium offering, which is built around, I originally was like, when I would talk to the company, I'd be like, so are you going to do a premium feeds? Or are you going to do subscriptions, blah, blah, blah. And they like, I feel like that phrasing rubbed people the wrong way. So I've started calling it creative empowerment. When are you going to do some sort of creative empowerment? Like, and I think it matters because like, to me, creative empowerment means more than just creating, a business model. It means you're giving creatives tools and you're giving them an opportunity to make revenue, right? You're giving them tools to kind of like enhance their creativity and enhance their ability to reach audience with their creativeness. And you're giving them like an actual way to make money. And in exchange, you take a little bit of a cut. And I think that would be something that could be $1 billion revenue line for Twitter down the line.
When you think about Twitter, one of the I don't know how to resolve it, but there seems to be this ongoing censorship issue with it, and it's meant that there have been some competitors like Gab.ai and Parler have popped up, and it's still, it's still in an ecosystem where we've discussed previously, it's not necessarily a social network in the way that Facebook is a social network or the way that Instagram perhaps is a social network, but it's still sort of thought of as in that kind of category of things. That style of things. So how do you see it resolving these issues and competing with sort of the new and the incumbents and whatever else comes along, TikTok?
Yeah, okay. So this is like one of the biggest, I think, challenges for Twitter. Say what you will about the president. He has put Twitter in a corner where no matter what decision they make, they're going to have people that are really angry at them. If they don't, censor might be too strong a word because I think they really just like added context to certain things that didn't actually censor. Let's leave semantics aside. If you don't censor, you're going to have a whole lot of people that are angry at you for letting him violate like very, not even gray area rules on their platform, black and white rules. Like why is this guy above the rules of your platform? On the other hand, if you actually do moderate or censor, then you're going to have a whole lot of people that are like, he's our president. How could you moderate or censor him? Like, he should be able to say whatever he wants. And so they were in a lose-lose situation. But the fact of the matter is, there are a lot of people who say things like, and I think this is one of the most mistaken impressions, that Twitter needs the president because he gives them engagement. And if you actually went around and spoke to a lot of advertisers, he is the worst thing that's ever happened for the platform, because no one wants their copy to be run alongside engagement that's based around things that get people angry. There's no one who's worse to market to than an angry person. An angry person is literally, they're factually putting up an emotional wall to being swayed on anything. So
I need to buy that gun now, Elliot. I need the gun immediately. I don't need the waiting time.
Right, exactly. Yeah, that's about all you can market. So yeah, people aren't like amenable to being swayed by marketing in those kinds of moments. So a lot of advertisers actually shut off entirely. So say what you will about engagement. I mean, that engagement is worth, I'd say, actually negative value, because advertisers will shut off in other areas. Now, the interesting thing about Twitter is politics is just one niche on Twitter, right?
It's best avoided, in my humble opinion. But
there's, FinTwit, which I think is one of the most amazing communities in the world. There's basketball Twitter. There's like a vertical. There's music Twitter. There's, and within every broad label, there are like very niche Twitters. And, I think there's, during COVID, I really learned a whole lot about the science Twitter community. There's a really big community around there. I'm blanking on the guy's first name. His last name's Danko. Wrote a great Substack about Twitter as the new peer review, and how a lot of science, in general, has been moving faster because of these communities that are built around Twitter, where you could share your research and get real-time feedback, like real good, critical, smart feedback that help you refine your own research process. And like, who needs peer review when you could do it in real time and kind of iterate your process and move it along that way? Like, that could literally only happen on Twitter. You're not going to do that on Instagram, where you're sharing pictures of yourself with your kids and your family on the ski slopes or something like that. It's just not the right format. It's not the right platform for it. Now, like TikTok, you mentioned TikTok. I don't think Twitter competes with TikTok at all. Obviously, it would have been nice had Vine still been in existence and they could try to create some sort of short form video. But I totally understand why they deprecated that product at the time. Twitter had thrown a lot of shit against the wall to see what would stick in their early days, trying to be something more glorious than they actually were. So they had to focus on their core essence. They had to redefine their core essence. I think they didn't have a core essence, which was one of the big problems. Like, everything in early Twitter was defined vis-a-vis Facebook. Like in their S1, they talked about wanting to get 1 billion users. And I don't think that was the right North Star. They should have been, redefining themselves around what Jack Dorsey inevitably understood was Twitter is about interest. It's about what you're interested in. They have an interest graph. And that's a big part of why, their advertising doesn't work the same way for DR as Facebook does. Because Twitter built their entire ad, process. They can't identify, I shouldn't say can't, because this is changing fast. They couldn't identify what I was interested in. They could infer based on who I followed what I might be interested in, but they have now, with machine learning, started learning what I'm interested in directly. They've started labeling things in topics, and people say oh, come on, it's so easy. It's not. When I say skate to where the puck is going, because I'm a hockey guy and I always talk about hockey, I might be talking about Twitter, the business, right? Am I talking business because Warren Buffett's used that quote? Or am I talking hockey? How do you know how to categorize that? These are really challenging questions, and there are a lot of gray areas. But now that they're able to have topics, that I'm able to subscribe to topics, that, once they infuse that in onboarding, I'll be able to onboard. And instead of having this white space where I knew a lot of people who I thought should find Twitter interesting, I had to manually onboard them, being I know you so well. These are the people you should follow. And, they now love Twitter and they're way too addicted. I know some of them are inevitably going to listen to this. You know who you are. But, I think, having that capability to actually know my interests instead of inferring my interests will make Twitter a better experience for me. It'll make Twitter more accessible to people who don't use it yet and can onboard. And by the way, there are a lot of people who had been registered as users and churned pretty fast because they didn't know what to do. So they'll re-engage those people. And then they'll also have a way better product for advertisers. Like what advertisers want is to actually know interest. They don't want to infer interest. You get way better results when you actually know what you're there for.
Yeah. Yeah, I think I said this to you yesterday, but the all the other platforms have the problem that when they get very hot, the issue is that it's great for the moment that it happens to you, but if you get very hot, then at some point the next generation that comes through doesn't want to be on the same platform, I think, as the older generation, which is kind of what happened to Facebook. They got lucky that they got Instagram, or smart that they got Instagram. And it's sort of happening to Instagram a little bit with TikTok. They're trying to recreate the same capability, but I don't even know if it's going to matter, because I think you just don't want to be on the same thing that your parents or older siblings or older people are on. Twitter has sort of never been really cool, and it's much harder to use, but once you're in it, it's much more useful, I think. So it self-selects for people who are going to be very sticky, which might mean that it grows a little bit more slowly, but it's also going to be a little bit more resilient.
100% agree. And I think there's a trade-off between slow growth and resilience. That's an awesome point, because I really think there's some truth to that. I wrote my last commentary about that very notion, and I didn't even apply it to Twitter. My God, I wish I could go back. But I think that's really freaking important. Like, I think that actually matters. Twitter has an appeal that's very different. These other platforms are on a treadmill competing with one another over who's got the best new feature and who's a little more interesting, and where can I make sure that my grandparents and parents don't see me tweeting, or maybe
right.
tweeting's the wrong, pushing out content that's not appropriate for their eyes. Twitter is about engaging in your interests. And I think, one of the realities that billion user aspirational number they threw out in the beginning didn't grasp was that Twitter shouldn't be for everyone. It should be for people who are really interested in things and really want to, indulge in those interests. And I think that's really good, because when you actually get that sort of platform, it's way more sticky and it's much harder to compete with. And, I've called it the funnel for anything interesting in life, because I've had so much serendipity from, we basically met over Twitter, right? I've met so many interesting people over Twitter. I talked to investors in the Nordic countries who I met over, a sports gambling investment, and that we otherwise in the prior world could have never gotten to know one another. So it's global, it's communal, it's a way that you actually meet people. It's so many different things that I don't think the other platforms are really geared toward. Like, those other platforms are more based on, TikTok's a little different, but like Facebook, it's purely based on who you know as friends and family. And, you love those people, but you don't necessarily want to, talk stocks with them all day. I would much rather do that on Twitter.
Right. I want to change gears a little bit, because we're going to run out of time, but I really wanted to talk to you about PayPal as well, because it's one of the stocks that I said yesterday, it's optically expensive. It's trading at less than a point of free cash flow. And I just wanted to, you had a very thoughtful approach to valuing it, and I just wanted to, if you could do that again for me, please.
Yeah, so one of the things I do in my process is I build a reverse engineered DCF. And I'm trying to look at what is embedded in today's stock price. And I'm going to go all the way up to the KPIs that lead to revenue growth. So what drives revenue growth? And so, the first thing I'm obviously trying to understand is what margins does the market expect this business to have? And, what sort of revenue growth do they need to kind of achieve today's stock price? But the next thing I'm going to do, once I have an understanding of that, is I'm going to test the sensitivity of each of the key lines and each of the key assumptions. And, in PayPal from the very beginning, I got involved in PayPal with eBay before the split. So I've been involved for a while. PayPal was once a really frustrating stock, much like Twitter is today, where, it's seemingly nothing could go right. And they similarly had a whole lot of code debt, and they had to re-platform everything to be able to kind of achieve some of their growth ambitions today. And then the other thing that they really needed was they needed Square to come along. Jack Dorsey, well done. And, create the Cash App and start doing things with a much broader mandate and, much faster. God, Jack moves fast, right? He's not the one holding them back. He's moved really fast here. And do things that are interesting and different and kind of, they really shook PayPal up, and PayPal realized that they had a much bigger, different opportunity than they had been pursuing at first. Now, one more step back is that Dan Schulman, when he came in as CEO, he had to work within an ecosystem in a really challenging way. When he came on as CEO, Charlie Scharf at the time was the CEO of Visa. Now he's at Wells Fargo, but at the time he was at Visa. And he was saying things like, I think his literal quote was, we view PayPal as our frenemy, and we will go nuclear if they don't play against them, if they don't play nice with us. And so Schulman had to really navigate this complex mosaic of players in the payment ecosystem who each had important roles to play. And what he did that was pretty brilliant was he struck partnerships with each of them in very constructive ways, where he aligned PayPal's mission of digitizing payments with each of these players. So all the players in the ecosystem now had incentive to kind of participate in driving growth PayPal's way. And so one of the things that I observed when I was doing this reverse engineered DCF and toying around with the numbers, everyone was obsessed with take rate at PayPal. They're like, my God, take rate's degrading. How could they ever drive incremental margin with take rate? And it turns out there's one other line that's really important. It's how many times users transact on PayPal per year, the engagement line, right? So I think at the time of the split, it was about 17 times a year. So you're not even talking about once a week that people are using PayPal. You're not even talking about twice a month, like 1.5 times a month, the average PayPal user would use the platform. And I said, right then and there, I realized there's so much leverage to this line in so many different ways. So for example, if you bring in a new user, you have to spend customer acquisition cost against that user, right? It costs money to actually acquire a user and bring them in. So if you bring a new person in to use it 17 times, I mean, that's great. It's got its core margin attached to it, though. But if you get someone who's already a user to go from 17 times engaged per year to 34 times per year, you have no customer acquisition cost against it. So that 17 times per year is worth a whole lot more than bringing in a new user. And
Right.
so interestingly, now we're at about 30 times per year that the average person engages with PayPal. So they've nearly doubled the amount of times people use the platform. And one of the things I do when I structure a position is I say, okay, I want to buy it when it's GARP, but I want to hold it when it's growth, right? So if I get it right, I'm really going to hold it through, their real growth period. And so, PayPal is definitely a little more expensive now, but the people that they're bringing on are so much more valuable than the people in the past because they're maintaining that higher engagement level. So when you think about what they've done since COVID pulled forward like 5 years of growth. They added more users in the first half of this year than I think they did the prior 3 years combined. And it's just phenomenal what that does when you kind of roll forward the economics of the business. So when you look at it on a trailing basis, the numbers don't look quite as good as what they will look like when you roll things forward, as they continue to bring on new customers, as they get engagement of their new cohorts to be consistent with their older cohorts. And then they're doing way more creative things in terms of how they get you to use the app and how you engage. One of the awesome things with Bitcoin, and I had been involved in Square. I'm no longer hold shares. I wish I held it a little longer. One of the interesting things in Square is that I think it was through Square that I first encountered when they opened Bitcoin trading. The average person who had bought Bitcoin opened the app twice a day. PayPal was having a challenging time getting people to open their app, right? Because you can engage with PayPal without opening the app at all. So you open it up to Bitcoin trading, and now all of a sudden you have people using it twice a day, and you have some valuable real estate. So if you open the app right now, in the app, there's a promo, get 3 free months of Spotify. If you click this button, how much do you think Spotify pays for that? That's really valuable. And next month it's going to be someone else. The month after that it's going to be someone else. So there's so many adjacencies and line extensions that they can now pursue that they didn't have the capability before because of their tech stack and because of what they were building toward, and because they didn't have this creative spark that Square has actually given them. So it's pretty interesting.
What does Honey do for
Yeah,
them?
Honey has a lot to do with that Spotify. I was really upset with Honey the day it happened. I was like, oh my God, these guys are blowing money. This thing doesn't make sense to me. And I totally understand it now. It makes so much sense. It was really smart. I mean, you could quibble over the price. One of the interesting things, their CFO from, he came in on the spinoff, John Rainey. He came from the airline industry, and in the airlines, you have to pinch every penny. So I do have some respect for the frugality that's at their heart. And, he made this commitment to acquire, I think it was about $3 billion worth of acquisitions a year, while moving their balance sheet from a way overcapitalized balance sheet to one of these more what you'd expect out of a payments company, like an optimized balance sheet. And they probably even eventually, they should gradually walk themselves to kind of 2 turns net debt to EBITDA balance sheet. And so Honey was an acquisition that kind of checked all the boxes for them in terms of the size. And I was like, well, oh my God, this thing doesn't really make a lot of money. It made $100 million and they paid, I think, $3 billion for it. What? That's pretty big. But interestingly, Honey gives them a lot of capabilities. Honey is an important way for them to get more information on purchase intent and to move up the funnel with their customers. And one of the things I always said about the PayPal split off from eBay is, had the company existed in an entirely different way, where it was PayPal that owned eBay and eBay was a service for their merchants, in contrast to eBay owning PayPal, the essence of the company would have made sense and it would have worked, but the actual existence was entirely backwards, and they couldn't rejigger that internally. So they existed to fulfill the wrong purpose. I actually presented it back in 2015 at Manual of Ideas, and I related it to Kant's categorical imperative, treat everything as an end unto itself. And they just weren't really doing it. They weren't pursuing the right end. Their end should have been facilitating everything for payment for merchants. They should have been in the business of serving merchants, and kind of Shopify is going there, and you see what that's done to their market cap. But Honey kind of achieves that ambition from a different angle in a different way, and let them actually start giving, literally on a platter, consumer intent to their merchant base. And that's something that they've never been able to do before.
Yeah, I thought that was a really clever insight. It kind of blew my mind when I first heard you say that. We've run out of time, unfortunately, Elliot, as much as I'd like to just keep on going with this. If folks want to get in contact with you, what's the best way of going about doing that?
I'm going to say go for Twitter. I have open DMs. Handle is at Elliot Turn.
What's...
ELLIOTTURN. And, always open to talking with people. And you can email me, elliot@rgaia.com.
That's perfect. Elliot Turner, RGA Investment Advisors, thank you very much.
Thank you so much, Toby.